Are you tired of complicated trading strategies with a bunch of indicators that make the chart look confusing? You spend hours staring at the screen, trying to make sense of those lines, only to take the wrong trade and watch your account melt after one fake breakout. We've all been there. But what if I told you there's a simple, powerful indicator that can help you read real money flow and make smart, precise entries without spending all day glued to your screen? That tool is VWAP. And once you understand how it works, you'll never look at the market the same way again. VWAP stands for Volume Weighted Average Price, and it's one of the most underrated yet powerful tools in technical analysis. While most traders focus only on price movement, VWAP adds the one thing that truly matters: volume. It doesn't just calculate the average price over a period like the simple or exponential moving averages. Instead, it weights each price level by the amount of volume traded there. In simple terms, the more traders that buy or sell at a certain price, the more important that level becomes in the VWAP calculation. That means VWAP gives you the true average price where the majority of the market's money is flowing. When price is above VWAP, it shows buyers are in control. When price is below VWAP, sellers dominate. But here's the magic: VWAP doesn't reset every few candles like an SMA or EMA. It's cumulative. It builds over the entire trading session, giving you a complete picture of where fair value really is. Think of VWAP as the institutional average price. Large players like banks and funds often use it to measure whether they're getting a good deal. When price moves too far above VWAP, it's often considered overextended, like a rubber band that's stretched too far. And when price pulls back to VWAP, it's like gravity pulling it back to its fair value. That's where the smartest entries often happen. For day traders and scalpers, VWAP is a game changer. Most retail traders lose because they chase price without knowing which side the real money is on. VWAP fixes that problem by showing you where institutional traders are actually active. The simplest and most reliable way to use VWAP is by waiting for price to pull back toward it, then trading in the direction of the main trend. Let's say the market is trending upward. Instead of buying randomly at the top of a green candle, you wait for price to retrace back to VWAP. If you see a bullish rejection candle or a rise in volume around that level, that's your entry point. It's confirmation that smart money is defending that zone. The same logic works in a downtrend. When price rallies back to VWAP and shows bearish rejection, that's your chance to short. VWAP acts as a dynamic support or resistance area. During an uptrend, price tends to bounce off VWAP. During a downtrend, it reacts as resistance and pushes price lower. Once you understand this behavior, VWAP becomes more than just a line. It becomes a map of market sentiment. It shows you where the market finds value, where traders are taking profit, and where new positions are being added. Now, if you want to take VWAP trading to the next level, combine it with the Fibonacci retracement tool, specifically the 50% and 61.8% zones. This is where things get interesting. Most strong price moves, whether bullish or bearish, tend to retrace halfway before continuing the trend. When VWAP aligns with that 50% or 61.8% retracement area, it forms a confluence zone that's extremely powerful. Here's how it works. After a strong bullish push, draw your Fibonacci from the swing low to the swing high. Wait for price to pull back into the 61.8% zone. If VWAP sits inside or just below that range and price starts to show bullish rejection, maybe a pin bar, a hammer, or increasing volume, that's a high probability buy setup. You're essentially entering where both technical structure and real money flow meet. In a bearish move, it's the opposite. Draw from the swing high to the low. When price retraces into the confluence area between VWAP and the 50% level and shows bearish rejection, that's your short entry. Always place your stop loss on the opposite side of VWAP, because once price breaks through, it means the dominant trend has lost momentum. VWAP is not just a visual guide, it's a line that separates control between buyers and sellers. A professional VWAP trader doesn't chase entries, they wait for confluence and structure. The best setups are those that occur near clear support or resistance levels, where price is unlikely to break immediately. A great VWAP setup is not about guessing tops or bottoms. It's about finding trades that have a natural, logical stop-loss point. If you buy near VWAP in an uptrend, you're protected by the fact that volume is supporting your trade. If you sell near VWAP in a downtrend, you're going with the flow of institutional momentum. Always look for confirmation from candlestick behavior, wicks rejecting VWAP, or volume increasing on your side of the trade. Don't enter just because price touches VWAP. Wait for volume confirmation. That's how you avoid getting trapped in fakeouts. VWAP isn't a magic crystal ball, but it is one of the most honest indicators in trading. It tells you exactly where the majority of money is flowing, and that's what really drives the market. When you learn to wait for pullbacks to VWAP, combine it with Fibonacci zones, and confirm with volume, you stop trading emotionally and start trading systematically. Remember, volume never lies. VWAP is the language of smart money. Learn to read it, and you'll always know when to take action and when to stay patient. If you got value from this video, don't forget to like, subscribe to Zeus Trading Cashback, and join our Telegram group through the link below to receive real-time trading signals and 100% cashback on your trades. Sometimes, the strategies no one talks about turn out to be the ones that change everything.